Welcome to this week's market drama. We'll begin with the S&P 500, which was down 2% for the week. NASDAQ was down even more, down 3%. Now, keep in mind, S&P is up 23% year to date. NASDAQ's up 24.4% year to date. So to a certain extent, giving some back after such a rally is not something that would be unusual. So were there any headlines to point to? Well, one, yes, we did have inflation data that came out for both CPI and PPI. They were both pretty much in line. CPI for October headline came in at 2.6%. This is slightly above where it was the prior month of 2.4, but pretty much as expected at 2.6. Core CPI, which excludes food and energy, was at 3.3%. That's as expected. So you can't really point to that and say, oh, wow, the market got that one wrong. Having said that, there were comments out by the Fed chairman this past week that definitely gave us a sense that the Fed is looking at the current economic data and saying, well, you know what, we might not have to lower interest rates as fast as we thought. The specific quote here is related to the U.S. economy remaining resilient. And he said, and I quote, "It is not sending us signals that we need to be in a hurry to lower rates." Right? So that quote definitely reminded the markets, hey, rates might come down a little bit more, but that neutral rate might be higher than we originally expected. And now the market is expecting 3 more cuts to get us to 4% versus before it was expecting more cuts. Right? So that is one headline that definitely caught the market's attention. Separate topic is I've seen a number of headlines related to the consumer balance sheet. Right? There was one headline, credit card debt hits records of 1.17 trillion. And that is true. The consumer debt has gone up a fair bit. But you know what? Consumers' wages have also gone up. Over the last 18 months, consumer wages have been growing faster than inflation. And also markets have gone up, right? And that is a big asset for the consumer's balance sheet. And so has housing prices have gone up, right? So when you put it all together, you can't just look at the debt side of the equation. You have to look at the asset side of the equation, as well as the discretionary income of the consumer. And when you look at it that way, the consumer's balance sheet is actually in pretty good shape. Yes, is not as good as in shape as it was, let's say, 2 years ago, but is nowhere the levels of where discretionary income to debt that we saw, for instance, in 2006 or 2007, when we were heading into the Great Recession that was caused because the household balance sheet was in really bad shape, right? So, for instance, household debt as a percentage of discretionary income is still around 11%. It went as low as below 10%, but just to give you a sense of kind of scale, when 06, 07 happened, it was above 13%, right? So yes, debt is going up, but so is discretionary income, so are asset prices. So the consumer is actually in pretty good shape, and you got to be wary of a headline that just points to one side of the balance sheet for the consumer. That is it for this week. Stay tuned for next week.